Hello and welcome to the session. Today would be the last of the days. Okay, today is the last day, and we shall complete this particular session. Okay, but how did we get started, and what are the various activities that we have performed? Let's start. We first, have taken a scenario where we thought if given two options, one is the risky asset and another is a risk-free asset. Given these two scenarios or these two investment options, and if you have money, where would you invest? Would you invest your money completely in risky asset? Or would you invest your money completely in risk-free asset? Okay. This was a scenario that we have discussed. Then we have built on top of that. And we thought, what if someone wants to invest not 100% on risky or 100% on risk? What if they want to invest some amount in risky and some amount in risk-free? Then what happens? For this, we came up with an equation, and that is called as capital allocation line. This kind of a line. And the equation of the line was given as expected value is equal to risk-free rate plus expected return on the risky portfolio minus risk-free divided by sigma into sigma. This is like y is equal to c plus mx. This one is x. And the slope of the line is given using this. All the portfolios would be here. If you want 100% risk-free, you invest here. 100% risky, you invest there. Anywhere in between would be in combinations. This is what we have discussed. Post that, we have moved on and we thought, what if we have, instead of one risky asset, say you have n risky assets? Scenario 2. Then what do you do? Then we looked at the specific formula on how the formula appears, and we compress that formula into matrix algebra. Okay, and we came up with this, that expected value on the portfolio is equal to W1 mu1 plus W2 mu2, and weights can be placed in a matrix called W, weights matrix. And you also have mu, expected return, and also you have sigma, wherein you have sigma 1 square, sigma 2 square, so on and so on. Then we have also looked at variance form. W1 square sigma 1 square plus W2 square sigma 2 square 2W1 W2 sigma 1. If you have two, we have taken a scenario of two risky assets. And today is the last class. Okay. Anyways. So here, this is W1 square sigma 1 square plus W2 square sigma 2 square plus 2 times of W1 W2. This sigma 1 2 is called as covariance. Covariance is written as correlation rho into standard deviation of 1 and 2. This is correlation coefficient, standard deviation. When you say rho equal to 1, this formula would change as W1 square sigma 1 square plus W2 square sigma 2 square plus 2 W1 W2, since this is equal to 1. If at all, rho equal to 1 means correlation between the two risky assets is 100%. They are very, very closely correlated. That is what it is. And this is similar to a square plus b square plus 2ab. And this is nothing but a plus b whole square. So given that context, you can write this as W1 sigma 1 plus W2 sigma 2 whole square. This is sigma p square. This implies that sigma p is equal to W1 sigma 1 plus W2 sigma 2. Okay. However, if rho equal to -1, this becomes sigma p square. Sigma is risk basically. W1 square, or in short again, instead of here, you put -1, so this becomes minus. So if you put -1, this formula would be like a square plus b square minus 2ab, which is nothing but a minus b whole square. So you will get W1 sigma 1 minus W2 sigma 2 whole square. And sigma p is equal to square root of this. So you write this as plus or minus W1 sigma 1 minus W2 sigma 2. This is how you write. These two equations are extremely important for a further discussion. What are those two? This one and this. These two are extremely important. And let me explain you that when sigma equal to 1, or when rho equal to 1, the equation is equivalent to this equation is similar to equation of line. And when rho equal to -1, when the two risky assets are completely uncorrelated, like probably you have one stock of Microsoft, which is from IT, another stock of Tata Motors, which is from automotive. These two will be completely different. There won't be any correlation. But here you have two equations. So you'll have two lines. It's also like equation of line. If you put plus sign, it becomes one equation, minus sign becomes another equation. So you get two lines. Here you have one line. Okay. Now, going back to our discussion. Suppose there are two risky assets. One risky asset gives you a return of 10%. Another risky asset gives you a return of 20%. You have the new matrix, expected return matrix. And then you have variance covariance matrix or sigma matrix. Whatever you have here, this is sigma 1 square, this is sigma 2 square. This is rho into sigma 1, sigma 2. This is also rho into sigma 1, sigma 2. Because in this matrix, right, you'll have like this variance of asset 1, variance of asset 2, covariance is always between two assets. Covariance between x2 and x1 would be equivalent to covariance between x1 and x2. So it will be the same. This is written as variance of x1, variance of x2. This covariance of x1, x2 is written as correlation between x1, x2 into standard deviation, sigma of x1 into sigma of x2. This also is written as correlation of x2 comma x1 into covariance of x2 and covariance of x1. This is how you write it. Then expected return of portfolio is written as W into expected return of 1 plus 1 minus W into expected return of 2. Variance part is written as W square sigma 1 square plus 1 minus W or W2 square into sigma 2 square plus 2 times of W into 1 minus W into rho into standard deviation. These are the formulae which we have already discussed umpteen number of times. Okay, we are not talking about these for the first time. We spoke about these multiple times. Now, for a given rho, for a given correlation value, we can trace out the expected return and standard deviation of different portfolios, means different combinations of X and Y. If you say rho equal to 1, then I already told you that it's equation of line. So if you have asset X and asset Y, rho equal to 1 means there is 100% strong correlation. But then what happens is, if you invest in X, which is say Infosys, and you have also invested in Y, which is say TCS. If Infosys stocks go up, return on the stocks, then TCS also will raise. Because there is a strong correlation. Both are from India, Indian-based companies. Both are into information technology. If one is doing well, another also will do well. But then, if your markets are bad, if one goes down, another also goes down. Okay, if Infosys goes down, TCS also goes down. This is a very bad scenario. When the markets are bad, if both of your stocks, if you invest in highly correlated stocks, then if one stock goes down, another also goes down. That's a very risky proposition. Hence, you need to diversify. Probably you invest in one IT stock, one pharmaceutical stock, one some other manufacturing stock, so on and so forth. Ensure that it is well diversified. If it is well diversified, Even if one industry goes down, another industry will take up. For example, if you would have invested completely in aviation, okay, or if you would have invested completely in, say, for instance, in hospitality, because of COVID, you would have gone bankrupt by now. I mean, at least the entire money that you invested in stock would have been gone, washed away. Okay. Hence, investing in diversified industries is always a very good option. Rho equal to 0.5 means the correlation between X and Y is less. The moment the correlation between two assets becomes less, the risk reduces. So if you have risk on x-axis or sigma, and if you have expected return mu on y-axis, then the moment you diversify, risk is reducing. It's not the same, risk has come down. If rho equal to 0, that means if you're choosing two assets which are completely uncorrelated, the risk is reducing on this x-axis. If you see, the risk is coming down. And if you say rho equal to minus 0.5, then X and Y are completely uncorrelated. I mean, they are negatively correlated. Forget about uncorrelated. They are negatively correlated. So risk is further reducing. Risk, if you look at this risk axis, it is coming down. It's going in this direction. And when you have rho equal to -1, already we have seen that equation that we have solved in this module. Initially, we have looked at that derivation. So you'll have two equations of line. Hence, it's like this. But then if you look at -1 correlation, meaning they are 100% negatively correlated. What are correlated 100% negatively? Assets, risky assets, X and Y. In this scenario, if you look at your risk, it is 0. 0. And expected return is some 14%, assume. Okay, expected return is some 14%. Now, if I were to draw a straight line like this, then you will get 14% return on investment, whether you are here or whether you are here or whether you are here or here, it doesn't matter, or whether you are here. You get 14% return on investment. But if I ask you, what kind of assets do you want to invest in? You would obviously choose this pink line where the two assets are 100% negatively correlated. Completely different stocks. Can you ever find two assets which are completely 100% negatively correlated? I doubt. You'll not be able to see those kind of stocks. But the idea that I'm trying to drive here is, when you start diversifying, okay, the risk will automatically keep reducing. So risk diversification happens to be one of the amazing risk reduction strategy. Now, if you have two risky assets, this is how it appears. What if I have three risky assets? Then what happens? If you have three risky assets, then assume that, okay, you have X, Y, and Z. X has an expected return of 10. Y has an expected return of 20%. Z has an expected return of 15%. And here is a variance covariance matrix. Along the diagonal, you'll always have variances. This is a variance of asset X. This is variance of asset Y. This is variance of asset Z. This is variance of XY, variance of XZ. Right? Here is the variance of some two other assets. So this is say XYZ, XYZ. So this is a correlation between Y and Z. In that way, you have the data. When you have two risky assets, there is one more thing that I want to tell you here. Suppose you are taking a specific risk, which is here. For that, and let me rather take a different curve here, just to ensure that I drive my point. If you're here, if you're taking some risk, if you look at the expected return, either you get this expected return or this 12% or maybe 15%. Where do you want to lie? 12% or maybe 15%? Anyone would say, hey, I want to be here. I want this. For the same risk, if you're getting more return, why do you want to choose something which is below that? Hence, the lower half becomes irrelevant. Only these curves would be relevant. These, no one wants to invest in. If I cut it horizontally, then this portion is what people would be interested in. This curve is what people would be interested in. Okay. All right. Now let me explain this. And this curve that you are interested in, or we all are interested in, is only the portion which is here. That curve is called as efficient frontier. Okay, that curve is given a name called as efficient frontier. So if you have two assets, X and Y, X, Y. Say here these two assets. Then the efficient frontier would look like this. All right. Now, say you have another asset and call it as Z. Say you have somewhere. Let me call it as Z. So the efficient frontier between these two would be like this. Efficient frontier between these two would be like this. Efficient frontier between these two are anyways given. Right? Put C here. So if you have these three assets, X, Y, and Z, these are, say, three risky assets. Using these three, you can come up with umpteen number of more portfolios. You can say, let me choose a portfolio here. And then this portfolio will contain, and let me connect with this. Then this portfolio, this efficient frontier would contain portfolios of Y and Z, because it's on this line, Y and Z, and X. Then if you choose a portfolio here and here, then it will be portfolio of X and Y and X, Y, and Z. In that way, all these will contain different portfolios. Out of all these different portfolios, the question is, which portfolio is the best? Can someone help me understand, out of all these various portfolios, which portfolio is the best? So out of all these assets, you can come up with something called as the efficient frontier, which is this line, which is kind of, mean variance portfolio. Okay. And this efficient frontier mean variance portfolio would be called as a most optimal portfolio. But how do we arrive at this is a question now. So for optimality, number one is you want higher expected return for a given risk. For whatever given risk, you are going to expect the highest expected return. Or you want to reduce the risk for given expected return. What does that mean? If I were to set this up as a math problem, then you're saying that either you want to minimize this or maximize this, right? So either you want to minimize the variance of the portfolio subject to a fixed expected return, whatever is the expected return. Some take fixed number. Or you want to maximize the expected return, not to maximize this, subject to the risk, whatever be the standard risk. This is what is going to help you formulate the problem. So you either might want to minimize the risk subject to expected return, or you might want to maximize the expected return subject to risk. Now assume that you have an efficient portfolio and someone is expecting 16% expected return. And these are the three ways. In these proportion only you need to invest in the stock. Now, what I shall do is, okay. At this point of time, let me quickly open maybe R Studio and help you understand on how to do this calculation quickly. This is all your own user-defined function that we are writing. Now, where am I getting these values from? Here. Say you have expected return of X as 10, Y as 20, and C as 15%. That is what you're writing. 0.12, 0.10, 0.20, 0.15. And you also have covariance matrix, which is going to have 3 rows and 3 columns. 3 rows, 3 columns. 0.0049, 0.000070, that will have 3 rows and 3 columns. Let me know. If you print the means, you get these. If you get the if you print covariances, you get these. Now, if you want the efficient portfolio, if you want to know how much should you invest in X, asset X, because we have 3 assets, right? X, Y, and Z. How much should I invest in X? How much should I invest in Y? How much should I invest in Z? If you want the answer, you just run this optimization. And if you look at the optimal, efficient portfolio values, you get 0.54. This much is what you need to invest in X. 0.74. This much is what you need to invest in your asset Y. But then if you look at X and Y combination, you get 1.28. So where will you get that 0.28 extra from? So what you are saying is short sell Z. Short sell means selling what you don't have. You borrow the money and then invest. That is what it is. So you borrow from asset Z and invest in these 2 assets. So how did it calculate these 3 values? Based on this, based on these optimization formula. Either you use this or this. It would ultimately give you the weights in what proportion you need to invest. If you're expecting an expected return of 22%, for example, all you need to do is change this to 0.2. Run it, and once again, get these. Now, if you want for 22%, I'll just change it to 0.2, and it says 0.26 in X, 1.66 in Y, and when you add these 2, you get 1.925, and that's Z is minus 0.9. Okay, now say you are putting a constraint that I don't want any short sellings. By the way, when it comes to mutual funds, if you want to invest in mutual funds, shorting or short selling is not allowed. But then if you're putting such constraints, a lot of companies, investment banks have these constraints that probably you cannot invest in some company which is going to negatively impact the health of people, like tobacco companies. You should not invest. There are a lot of such constraints. You should not invest more than 5% in any specific industry, companies of any specific industry. In that way you have. Obviously, your unconstrained efficient frontier would have more return, but the moment you put constraints, your efficient portfolio will, the expected return will come down. Here you have expected return. For the same money, for the same risk, for instance, of course, we'll ignore this part. In constrained, you get only so much expected return, but on unconstrained, you get more expected return. And another thing is, as in how you keep adding more and more assets. Of course, diversified assets. What will happen is the risk will keep on reducing, keep on reducing. But then if you keep continuing to do that, you might assume that it will touch this and become zero magically. If you keep investing in a lot of assets which are uncorrelated, if you keep investing in that way, if you keep diversifying, eventually you might get an impression that these frontiers might touch here. If it touches here, risk is zero. But that would not happen. Okay, that would not happen because some amount of risk would be there because of the very nature, very nature of the place that we live in. And that risk is called as systematic risk. The systematic risk will remain no matter what you do. By diversifying, that is by investing your money in well diversified assets, the only thing is you're reducing the risk. But even this diversifiable risk is a risk that can be reduced to some extent. If you keep on adding more and more assets, it will reduce. But systematic risk will not go away. It would still remain. So we now understood that if you have risk and return, capital allocation line will tell you whether if you invest in completely risk-free, you'll be here, completely risky, you'll be here. And if you want to invest 50% in risky and 50% in risk-free, you'll be here. In that way, you have the complete allocation of portfolio. If you have only two, that is risky and risk-free. But if you have risky assets, forget about risk-free, only risky assets, then you get efficient frontier like that. Efficient frontier. Okay. So one more quick thing, friends. This session is planned only for 5 days, 1 hour each. And this same session will get repeated once again later. And that would probably be for 10 hours. And that is when we will solve it using Python as well. But for now, just R. We can also use Python. We'll look into that aspect also in the interest of time. Whatever best we can do, we are doing. But yeah, certainly later on, you'll be notified on the groups and you'll also have this. Okay, now, if you were to bring in the scenario where you have one risky and one risk-free, you have a cap. But in scenarios where you have n risky assets, you'll have an efficient frontier like that. But I mean, all these n risky assets, you mashed it into one efficient uh, frontier or one efficient curve. You can invest anywhere on that. Now, if I were to bring in this risk-free asset, how would it look like? It will look like this. So you have your efficient frontier. And if you have one risk-free and one risky asset, that is X, you get a capital allocation line like this. If you have one risk-free and one risky asset like Y, you get one capital allocation line, which is like this. And you have the efficient frontier, wherein you have only risky assets. Now, if you move that line slightly above, and if you can draw a tangent which exactly touches this efficient frontier, that would become your mean variance efficient frontier. So what are we doing now? We are trying to add a risk-free asset to the three risky asset scenario that we discussed. We had three risky assets, X, Y, and Z, and then we got this efficient frontier. The moment you add a risk-free asset, you get a capital allocation line like that. And wherever it exactly touches, that's your mean variance efficient portfolio or tangency portfolio. Mean variance efficient portfolio or tangency portfolio. That's how we deal with it. Now, another big picture which we are yet to discuss is, where is our risk attitude, risk aversion? We didn't discuss about that. Hold on. So here, friends, depending on what is your risk attitude, you either would like to fall here, that is, invest this much amount in T-bills and rest in risk. So you're more inclined towards risk free if you're very close to it. Here you have A equal to 50, that guy would lie somewhere here on the mean variance efficient frontier. But then, if you were to understand what was happening is, to calculate these things, that is, to get your capital allocation line or to get your efficient frontier, we need expected values, variance covariance values, and we also need a value. Okay, we also need value of A. Certainly, to calculate, we need value of A as well. And then to get value of A, it is not going to be an easy affair. So just give me a minute while I try to pull up a specific document. And that document, I just pause my screen share because I want to pull up a specific document for you guys. So this is the document. What does this document indicate? Okay, so this document indicates that you can get the value of A, and you can get that value of A by looking at two different values. And this document, you can always also find it on internet, and it's called as portfolio optimization with mental accounts. A guy by name Sanjeev Das and Harry Markowitz. Against his name, we have this algorithm which is called as Markowitz algorithm. That's how just remember that there is something called as Markowitz optimizer, and Harry Markowitz has come up with that will help you basically identify the value of A. One second, friends. Why is my mouse cursor not even moving? Strange. Okay, not sure. Okay, anyways, now it's working. So here, if you observe carefully, they came up with values such as P and alpha. So let me write it here. Probability of return on the portfolio should be less than or equal to H, where H is given as threshold. Less than or equal to alpha, where alpha is another threshold, or let me call it as tolerance. If someone says the probability of return on my portfolio should be less than or equal to minus 10%, means that's my threshold. If I'm going to invest $100,000, I don't want to lose more than 10% of this. More than 10% of this, I don't want to lose because that's my threshold. As an individual, that's my threshold. And if I say less than or equal to 5%, which is your tolerance, it means more than 5% of the times, I don't want this scenario to arise. I don't want to lose more than 10% for more than 5% of times. And then people started forming, or not people, the folks here, Sanjeev Das and Harry Markowitz, they decided that now using this H and alpha values on return, H and alpha values on education, they asked bunch of questions. And using these two, they could come up with A values. So H1 alpha 1, H2 alpha 2, A2. In that way, they came up with some values. They used to ask people, okay, if you lose more than 20%, because we are investing in stock and there will always be that risk. Okay, if you lose more than 20%, are you okay with that? If you lose more than 30%, are you okay with that? The customer says, no, I'm not okay. So what is the maximum money that you're willing to lose? They might say, you know what, 10%, not more than that. Okay. If you're losing more than 10%, say 2 times, 3 times, 4 times, 5 times, in a year, if you have say 250 trading days, out of that, if you lose more, if you lose up to 10%, for say 5 days. Are you okay with that? Or 10 days? Are you okay with that? If customer says no, no, not more than 5%, that means if you have 250 trading days, 5% of this, maybe for approximately 12 days, if I'm going to lose up to 10%, I'm okay. That too, 12 days out of 250. If it's more than that, I'm not okay. As a customer, I'll be dissatisfied if that happens. So using these combinations of H and alpha, which is threshold and tolerance values, people came up with A. Okay. And once they came up with A, there were a lot, it was a lot easy for them to plug the values into the equation and just solve it. And this efficient frontier thing, which we have spoken about, the efficient frontier thing that we have spoken about takes inputs which are expected returns, mu1, mu2 in that way, then variance values and covariance values of your different assets. Supply these to your optimizer. In R, we have already seen that R studio, right? Markowitz optimizer. And then, thanks to this, you get something called as efficient frontier. So if you have one risky asset, one risk-free asset, then you get a capital allocation line. But if you have n risky assets, then you can come up with that efficient frontier. And then if you want to bring in the risk-free asset into picture, then that line, which exactly touches this efficient frontier, would be called as mean variance efficient portfolio or tangency portfolio, because it's a tangent. Tangents. And if depending on your A value, either you'll fall here or you'll fall. It depends on your A value. Okay, and that A value is calculated using H alpha pairs, which was proposed by Harry Markowitz and Sanjeev Das and some other guy. Okay, so until here we have discussed. I'll stop here. And let me tell you that we are once again going to come back to financial analytics, and we will certainly post about the information on our social media, on our YouTube channel. Events will be created. So please subscribe to our YouTube channel so that you're notified. And then we'll talk about a lot of additional things in this space, Black-Scholes technique and so on and so forth. And then we will eventually conclude. So I'll stop here, friends, and thank you so much for joining in. And I'm sure you have learned at least a few meaningful things here, which will help you either do some kind of projects, or maybe it is going to help you in your interviews. Thank you so much once again, and have a great day. Good night.